This week we had some massive companies report their earnings. Today's episode we are focusing on Intel that has reported yesterday after close, and in fact we will be taking a look at some other of these companies that have reported over the next few days. Now Intel, they have reported their earnings and they are down nearly 8%, which when the market opens will bring them very close to their 52-week low. And we're going to take a look in today's episode at their earnings, why exactly it was so poor, what the market saw. And as always, we're going to look at this company, look at their revenue growth, look at their bottom line net income, and also understand the health of this company, their total cash versus total debt, as well as taking an actual look at their investor presentation from yesterday to see whether or not there is some growth opportunities and the market is giving us a very strong opportunity. As always, we will look at both insiders as well as institutions to understand if they are buying or selling. And as always, we will run them through the valuation model, getting to our intrinsic value as well as our acceptable buy price given that investor margin of safety, and look towards Wall Street to see what they're estimating for the next 12 months in terms of upside and growth. We will also touch upon their dividend safety, look at it borderline safe, also see their financial metrics, free cash flow as well as others, and we can also discuss whether or not there is another dividend cut on the horizon. Now, when we take a look at Intel, what we first want to see is year to date how the market has performed. We can see across the board very mixed numbers. A lot of companies up very strongly double digits, and some in fact the same, however negative. When we take a look specifically at the semiconductor industry, what does really stick out is Intel, which is down 30%. Now this will be down even further when the market opens. As we can see, it is already down nearly just 8% after yesterday's very poor reaction to what they reported. Let's take a look at why the market reacted very negatively, and we can see the headlines does read that Intel shares fall after company provides a weak forecast for the current quarter. So what I always like to do is to start off with analyzing how they performed versus analyst estimates. And what we can see, a nice beat on the earnings per share, 18 cents, with the market anticipating 14. However, what we did note was that their revenue was slightly under, 12.72 versus 12.78 expected. Now that isn't necessarily grounds for the market bringing this down nearly 8%, but what we can see here is their estimation for the next quarter. For the second quarter, they are expecting earnings per share of 10 cents with revenue around 13 billion. Now, what was the market expecting? Well, a significantly higher earnings per share, 25%, and they were expecting slightly higher sales of 13.57 billion. So, not the greatest at all. It is a bit of a worry if you are a long-term investor. We can see 18 cents was what they had reported, and now for the next quarter, not only is it down to around 10%, but the market was expecting their earnings per share quarter on quarter to actually have some improvement. So not great at all. Let's take a look at this company. Is it undervalued now with the drop? Is it one we can take advantage of, or is it one we should consider to stay away? Now, year to date, it is down 30%. It is going to be more towards 40% when the market does open in the next few hours. As we mentioned, it will also be right there towards their 52-week low. We do know one buy rating seeking alpha with both Wall Street and Quant giving it a hold. And we note right now the forward yield is at 1.45% with a forward PE sitting at 25.48, slightly higher than the S&P average of 22, although this will probably come down to near those levels when the market does open. Now, if you've been a shareholder over the last 10 years, you would be up 32%. Although that doesn't include dividends reinvested, that is a very terrible return on any investment. And we can see the highs of around $68 was quite some time ago. You'd have to go back, in fact, just over 3 years to see that with this company. So is there opportunity here? Let's find out. Now, what I always like to start off with is looking at their revenue growth. Year on year, we do like to see 3 to 7% as a minimum for that stable company, at least keeping up in line with inflation. What we know over the longer term, they have gone from around 56 billion in 2014 to around 54. So in fact, they reported higher revenue in 2014 than they did in 2023. But what we can see, it has gone through a period of a lot of inconsistency. It was increasing up to around 2021, and then we have seen it has started to come down. So not a great sign at all. So we can understand why this share price has been plummeting over the last 3 years as well. It is starting to make sense. How about the bottom line net income? What can we derive from that? Well, it's never a great sign when a company made more net income, 11.7 billion in 2014, than they did in their latest annual accounts of 1.7 billion. So whilst their revenue, as we saw, did in fact decrease very slightly, we do see their bottom line much lower than what it was 10 years ago. And a lot of inconsistency over the period. So that is a little bit of a red flag right now. So let's take a deeper dive at this company. Let's look at the health. Is it healthy? What's their cash versus their total debt position looking like? Well, their cash has increased and short-term investments from 14.4 billion in 2014 to around 25 billion in their latest quarterly report. So we can see over the longer term that cash has been increasing. Now, what I do quite like to do is compare that to their total debt numerically and directionally. And what we can see, their debt has also increased quite rapidly from 13.7 billion to around 50.3 billion. So their cash has increased slightly, whereas their debt has been increasing at a much faster rate, something we really need to consider when we do take a look at their dividend safety, as well as that net debt to EBITDA metric. How about their growth rate? Now, we do want to take a look at a few of their metrics, and we do know they have a D-, a very poor score. When we take a look and understand why, well, their revenue year-on-year growth, negative 14%, when the sector median is at 4%. Forward-looking, very marginal growth, in fact, looking more like flat, with the median expecting around 7% in this sector. And we can see just across different metrics, not great at all. However, one thing I do quite like to take a look at is their earnings per share on a forward basis. What is it expected to grow by over the next 3 to 5 years? We can see 25%, with the sector median coming in a lot lower at 13.7, although I am starting to question this when we do take a look at their forward guidance and their investor presentation, at whether or not this is something that they can deliver. Then when we look at their profitability, a much better scenario here, A+, so very positive. Gross profit margin, however, 40%, with the sector at 49%. When we take a look at their bottom line, marginally higher, 3.11 versus 2.52. So lots of different metrics here you can take a look, but overall on a profitability, it is showing a much nicer picture than when we did take a look at the growth and we saw that D- rating. As always, let's take a look, compare how your investment over the last 10 years in Intel would have compared to others in the industry like Texas Instruments, Micron Technology, Qualcomm, as well as a few others that we have reviewed not too long ago. So over the last year, if you were reinvesting those dividends, you would be up 23%. Bear in mind that this price was very low not too long ago, hence why at this period you would be up significantly. Does depend though at what point you invested. As we can clearly see, if you've been an investor over the last 5 years, even after reinvesting those dividends, you would be down 30%. If you've been investing over the last 10 years, you would be at least up 75%, but a few things to note. One, you would be the worst performing out of these competitors, and two, over the last 10 years, if you are reinvesting a dividend and you are getting just double-digit return, like we can clearly see here, it isn't great at all. But on the flip side, past performance is never an indicator of future performance. So again, bear that in mind into your investment thesis. This is just one layer of review that we always do. When we take a look at insider ownership, we see 0.04%, with 2 insiders selling over the last 12 months, totaling 1.57 billion, with 1 insider buying just under $1 million. Now, we do have to go quite way back to see the insider selling. It was in Q2 of 2023, although we do note insider buys in Q3 as well as Q4 of 2023. When we look at Q1, another insider buying. Q2, nothing to note yet. And when we take a look at who this is, we can in fact see that the CEO, Patrick G, did in fact buy at the end here of January and the beginning of February. In total, 5,800 shares and a price around $43 in combination. Now, what we can see right now, the share price is significantly lower than that at $32.50. So take that with a pinch of salt. We do like to say that these are a sign of a bullish because insiders buy because they believe the share price will go up. But as always, no one knows what the future will hold, and I'm sure he would have liked to have bought this at a much lower price. Now, how about institutional ownership? 64.53%, 7.58 billion worth of sales over the last 12 months, and during the same period we see 20.54 billion worth of buys. So institutions are buying more than they are selling over the last 12 months, but what we note here is in the latest quarter a little bit more selling by those institutions. However, throughout 2023, every single quarter institutions were buying more than they were selling. As always, do your own due diligence, but it is quite interesting to note. Also, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any of our other articles, all completely free, do click on that pinned comment below. So let's take a look at their investor presentation deck from Q1 earnings. Again, was released just last night, and a few things that we want to highlight. So we have their Q1 financials. We did take a look earlier, however, that was based on analyst estimates. What we can see for the quarter, 12.7 billion of revenue. It is up 9% versus the same quarter just last year. Gross margin, 45.1%, again, up 6.7 percentage points from the previous quarter of last year. And we do note that their earnings per share, 0.18, up 0.22 year on year. So what we do note then, it does look fairly strong in comparison to the same quarter from 2023. A few highlights that we also wanted to draw your attention is that whilst they're increasing revenue, as we can see over the last few quarters, it did in fact drop in Q1 2024 versus the previous quarter. So yes, we know Q1 24 is an increase from Q1 23. However, when we compare it to the previous quarter, it is down. On top of that, not only has the revenue come down, but their operating margin has also come down. So a bit of a deadly combo. You never really want to see this in any company you invest in. What you want is not just increasing revenue, but also increasing margins, as we have seen on this channel when the likes of companies like Nvidia have been reviewed. So something just to factor in. How does their next quarter look like? Well, they are expecting it to be flat from the same quarter last year, 12.5 to 13.5. Gross margin, however, they are expecting it to be up by around 3.7 percentage points. However, they are expecting their earnings per share to be down, not just from analysts who were expecting 25 cents, but also from the same quarter last year. Hence why we do see that share price plummet down. And it does, in my opinion, look like it will continue to fall when the market does open. So we may, in fact, see an all or 52-week low. Now, dividend safety score, it is 60. It is borderline safe. Market cap 149 billion, a mega cap company. Now, in terms of the last recession, well, in fact, they maintained the dividend during the 07-09 crash. They had negative 18% sales, which again was below the average of the S&P around negative 12. And they also had a marginal beat, negative 49% return, with the S&P a negative 55. So let's take a look at the dividend. Not really great for dividend growth investors. They did cut it massively just last year, in fact, February 23. Over the last 5 years, negative 9% year on year. However, over the last 20 years, if you have been a shareholder, on average, you would be up 12% year on year. They have also got those 0 years of consecutive increases due to the fact that they had that dividend cut in 2023. Now, when we take a look at dividend yield theory, what we can see here is something that I would say is maybe a little bit irrelevant this time due to the fact that Intel did have a much higher yield before the cut. So this isn't really a fair comparison. So we will put this to one side for now. But on the forward PE, what we do note, it does currently sit higher than the 5-year average of 13.4. Now, when we take a look at the sector, it isn't too far off as well, the information technology of 25.4. Well, with the dividend safety, a lot of things come into play, one of them being the free cash flow. Now, typically, I like to see 60% or lower. That does give me faith that management are able to offer those double-digit increases. 50% for semiconductors. What we effectively note here, it is negative because they would have had negative free cash flow in 22 and 2023. This is expected in FY24 as well. So something just to consider when you are looking at your own investment thesis for this company. Because what do we always say on this channel? You want to invest in companies with increasing free cash flows year on year. And what we do know for Intel, this isn't something they have managed, given the last 2 years on the free cash flow has been negative. FY24 again expected to be the same. Sales growth, well, no surprises given we did analyze their top line revenue. In fact, 2014 had higher sales than 2023. Last 2 years, double-digit negative growth. And again, another format on the right of seeing those revenues that we analyzed earlier. What they have done, however, over the longer term is return that excess cash. We do see share buybacks, but we do also want to point out that even though they have bought back a large number of shares on a net basis over the last 10 years, from 2021 they would have started to dilute your position as they have been increasing those shares outstanding. ROIC, as always, I like to see 10% or more. Industry specific for semiconductors, 12%. It does give us faith that management can essentially and effectively allocate their capital. But we see here it has dropped significantly, 0%. This is a red flag indicator in my opinion. So do factor that in. And if this company still does interest you, it may be one to allocate a large enough margin of safety. Operating margin, well, up to 2021, it was looking very strong. It has dropped again over the last 2 years, which makes sense given their share price has been obliterated during this period. And the same can be said for the free cash flow margin. Up to 2021, it was looking very strong, especially when you consider we are looking at a minimum around the 5% level. Now, in terms of the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, this does correlate to dividend safety and balance sheet strength. So the fact that we want to see below 1.5 and it is above that in 2023 is another red flag indicator. 2024, it is expected to come down, so that is nice to see. But do bear in mind that these are the number of years that it would take the company to pay off their debt net of cash on hand. If this does get very high and the free cash flow payout is looking very poor, then this dividend again could be one to be considered for a cut. Right now it doesn't look likely, but quarter on quarter, year on year, we will continue to analyze this and update if our thesis does change. In terms of the valuation, let's get in. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do start off with Graham's valuation as well as the multiples. However, their earnings per share has dropped massively, so it wouldn't be right or relevant to include. We start off with the dividend discount model. The average growth over the selected period coming in at just under negative 9%. Now, we have gone a lot more optimistic at 6% moving forwards. As we can see, they were having around 5%, so you could argue this is more on the optimistic side. With the intrinsic value, we get a value of $27.56. We have an overvaluation signal here. As always, though, do bear in mind we don't look at any of these models in singularity and will conclude shortly. We then have the free cash flow year on year, and we can see it is negative. Average growth, negative 14.3%. So we have factored in two things into our model just to be aware. First one, for the next year, 2024, we have gone for free cash flow similar to the 2021 model with a growth rate of 6%. With our discount rate, this gives us the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get an intrinsic value of $43.63. Remember, this is on the basis that they are able to increase or start to increase their free cash flows at 6%, and their free cash flow for 2024 is in line with 2021, which is roughly in line with analyst targets. When we take a look at their intrinsic value, then this is just the average of these two models, and this is coming to a total value of $36 or just under. As always, you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on the pinned comment below. So we start off with a margin of safety. As always, we start at 10% and we execute on that if it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that Intel hits all those 3, then you would be looking at an acceptable buy price of $32, not too far off the current price. So right now, in my opinion, 10% MOS level for Intel, it isn't one that I would be looking to buy. And in fact, Intel as a whole isn't a company that I'd be looking to add to my portfolio. I do believe in this space, if you want exposure to the semiconductors, there are a lot better companies that are even trading at a much higher margin of safety for the future that we have covered quite a lot over the last few weeks. However, do let me know your thoughts in the comments below. Wall Street are essentially predicting around $37, upside of 16%. So they do believe this is a hold right now. They do see limited upside, 16%. Again, there are many others that we have covered with over 25% upside in this space. And we can see The metrics for this company are deteriorating. The margin has dropped, their revenue has dropped, their earnings per share they have forecasted over the next quarter is looking very, very weak in comparison. 25 cents was what the market wanted. 10 cents is what they are now estimating. As always, though, do let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.